Hey guys, TommyBryson here, and today we're going to talk about M1 Finance and how I started using it and why, and also what is my strategy, how it works, what I like, and also what I don't like about M1 Finance. So by the end of this video, you should know exactly how M1 Finance works, and on top of it, exactly if it's right for you or if you might actually want to stay away from it, okay? I'm going to cover the pros and cons and be a 100% non-biased. And on top of that, if you're new to my channel, guys, I post on the channel every single day, so make sure to also subscribe to the channel and hit the bell so you're notified if there's a video, and on top of that, also destroy the like button for the YouTube algorithm. Now, the first thing is this, guys. As far as M1 Finance and what I like and also what I don't like, I want to start off by praising the company on the things I actually do like and do enjoy about M1 Finance, and then later on, I'll tell you exactly what I don't like, and then I'll share with you guys my portfolio and give you a way to actually copy and paste it so you can invest into exactly what I also invest into. Now, here's the first thing about M1 Finance that I actually do enjoy, guys, okay? The first thing is this. I like the freedom to create my entire own portfolio based on whatever I actually want to invest into. Some apps don't allow you to basically like create whatever you want to create, and in reality, M1 Finance is a great job at letting you create a portfolio around whatever goals you actually have. For example, right now, I can go, for example, into the research tab, click research, and then type in, for example, well, let me add another pie. So click the plus button on the top, click that, and then I can go ahead and build a portfolio or a pie in accordance to what I actually am interested into and what I actually want to invest into. So say, for example, I wanted to build a portfolio, for example, with Google, Apple, or Microsoft, and I wanted to divide my money individually into every single one of those investments right there. So I would just click plus, and I will add, for example, Apple, add it, Microsoft, add it, and also Amazon, add it. If I want Google, I can also add it, maybe even Facebook, and then boom, right then and there, I have a portfolio with 5 different stocks I want to actually go ahead and invest into. All I have to do is click done, and boom, there you go. There's my portfolio right there. I can save it, name it whatever I want to name it, and then I can go ahead and start investing into it automatically with just $25, okay? And the cool thing is that, guys, if you guys know exactly, Amazon is like $2,000 per share. Google is like $1,500 or even more by now. Apple is like $400, $300. So the answer is, if you bought one share of these companies, it will take you forever. However, if you just created, for example, your own M1 Finance, you can just invest, for example, 20% into Google, Amazon, Apple, Facebook, and Microsoft all together at once, and just with $25, and don't need to worry about all the money it would take just to buy one of those investments, okay? And that's another cool thing about M1 Finance that I actually do like. Now, the second thing I actually like about M1 Finance is basically something called dynamic rebalancing. Now, if you don't know what that is, it's okay, I'll break it down here. But say, for example, you wanted to invest $100. And again, you have 5 holdings and you're going to put in 20% into each of them. So in reality, you're going to have around $20 into each and every single one of these investments right here. Now, the idea is, okay, some years, maybe Google might do better than Amazon. So eventually, maybe your entire portfolio might be off because your entire goal is to be like, hey, I want 20% in this company, 20% here, 20% here and here and here. But the answer is, I don't want it to go like overboard because that way I'm more balanced out, okay? If all my investments go into Amazon and Amazon crashes, then next thing you know, I might lose all my money, right? That's the idea there. However, every single time, for example, your portfolio loses balance, for example, say Google did very good. It went up from 20% to 25% of your entire portfolio. The answer is, every time you invest into your M1 Finance portfolio, they go ahead and grab that money and put that money towards the other investments. That way those grow and go back to basically 20%, and your whole portfolio goes back to actually being balanced. Now tell me, why is this a good thing? The answer is, well, if you have a very intricate, very complicated portfolio, you want everything to stay the exact same percentage, and that way you're protected. But by doing it this way, automatically, it means you don't have to sell off shares at the end of the year to bring everything back to its balance. So if one is like 25% and it should be 20%, it means you don't have to sell 5% of your investments to go back to normal. The answer is no. Just by investing, it does it automatically for you, and that way you don't sell off investments. And by the way, whenever you sell, guess what happens? You also get taxed on the money you actually made, and you also want to avoid that, and that's why dynamic rebalancing is so important to me. And that's another thing I actually do like about M1 Finance, and also why I'm using it more often than ever now. Now, we spoke about what I like about the app, okay? I like my freedom to make my own portfolio. I like being able to go out there and basically buy whatever investment I want to buy, but with fractional shares. And I also like dynamic rebalancing, and that way my portfolio stays 100% balanced. I like that without having to go ahead and pay taxes by selling off my investments to bring it back to its balance, okay? So I like all this stuff. But Tommy, what don't you like about M1 Finance? And to be honest, it's just one thing. And that one thing is called M1 Finance Plus. Now, as you guys know, okay, almost every single investment platform out there has started creating their own debit cards. For example, I have the Robinhood debit card. I also have the SoFi Money debit card. But guess what? The Cash App has a debit card. Stash App has a debit card. And Acorns is a debit card. A bunch of companies out there have debit cards. And most of the times, all those debit cards are free. However, M1 Finance actually offers a lot more benefits with their debit card and their entire spend account. But it is also very expensive. Now, let me explain here, okay? The M1 Finance Plus account, I'll tell you the benefits and I'll also tell you exactly how much it costs. Let me tell you how much it costs first, and then you can tell me at the end, Tommy, is this worth it? The answer is going to be no. I'm telling you right now, spoiler alert, okay? Now, M1 Finance Plus costs around $125. However, if you go ahead right now and sign up, they let you sign up for around $40, $39.99 for the first year, but then after that, it's around $125 every single year. And to me, that is very expensive, but it does have some features that might make sense for you. And the first thing is this, guys. Whenever you're investing into M1 Finance, they have something called trading windows. So right here is my portfolio, but if I wanted to invest money right now, the answer is, guess what? It has a trading window. So at 9:30 a.m. on Monday through Fridays, they'll go ahead and make my trade actually possible. They execute the trade right then and there at 9:30 a.m. So if you wanted to invest the same day and you miss a trading window, then you have to wait until tomorrow to go ahead and make that investment. But if you get the M1 Finance Plus card, they'll let you also invest at 3 p.m. and that way you have 2 trading windows to go ahead and invest money. If you ask me, Tommy, is that worth the money? The answer is no. It is not worth the money, because if you really cared about, hey, I want to buy at this price and that price, you would just go ahead and invest with Robinhood or also SoFi Invest and buy at that same price right then and there, okay? You don't want to wait until 9:30 a.m. or, for example, even 3 p.m. And I wouldn't pay much money to basically buy an investment at 3 p.m. or 9:30. I would just use Robinhood or SoFi Invest and do it for free, basically, okay? Now, the second feature that M1 Finance Plus offers is called Borrow. Now, that also comes with like the normal one, but the normal one, it'll charge you around 3.5% of the money you actually borrow, and you need to have around $10,000, and you can borrow up to 35% of your portfolio, meaning if you have 10K invested, you can borrow around $3,500 and you have to pay an interest 3.5% every single year. However, if you have M1 Finance Plus, they'll only charge you 2%, meaning you get a 1.5% discount. Now, this to me is pretty cool, right? But again, I don't plan on ever borrowing money to go ahead and invest and basically leverage it against my investments. That just puts a lot of pressure on my investments to perform, and I don't need to go through that. So basically, I won't really be using this feature, but it's pretty cool if basically you had $1 million in there and you borrow 35%, that's around $350K at only 2%. And in reality, if you think about it, guys, okay, imagine borrowing $350,000, okay? And all you have to pay is 2% a year times 0.02%. That's around $7,000 in interest every single year. Divided by 12, that's only $583 to get access to $350K. That is an amazing deal. However, if you're not going to use it, the answer is you don't need it, so why pay for it? It's kind of like paying for extra cheese, but you're like, what is it called? Like lactose intolerant? Like you get the extra cheese, like good deal for you, but you're not going to eat it either way. So this, although it sounds cool, I'm not using it, so I don't need it. At least not for right now, so I wouldn't pay that $125 to get a feature that I'm definitely not going to use. And the last thing about M1 Finance Plus is that basically they give you 1% on the money you actually have in there, like a high yield savings, and they also give you 1% cash back on the card. So total is around 2%. Now it sounds pretty cool, right? But in reality, if I wanted to get money on my savings, I would just go ahead and get a high yield savings and get like around like 1.5% out there, okay? Competitive rates. And for that, I would probably use Vero, and Vero still offers around 2.8% if you have direct deposit set up on your first $10,000, okay? And even after that, they still offer a higher rate than 1%. And when it comes to like, hey Tommy, but the 1% cash back, bro, you can just use a credit card that gives you around 2% cash back. For example, the Citi Double Cash card. And then boom, you get 2% from that, and then 2% from your savings. And the answer is a lot more than getting 1% here and 1% here. And by the way, the cool thing about the SoFi debit cards is that basically I can use any ATM worldwide, and they'll basically reimburse me the ATM fee for free anywhere in the world. No ATM like, oh my gosh, only like these ATMs. No, the answer is anywhere in the world I can use this card at the ATM and get my money back. Again, this card, although I'm paying $125, I'm not getting any of that stuff. And I pay for this one right here $0, and for this one, $0. And that's basically the things I don't really like about M1 Finance, and I don't think right now in any way this $125 is actually justified, okay? So I don't like it. Unless you're going to use it to borrow money at a very low rate, and that's the only way I can justify it. But in reality, it's not worth it for anything else out there. And it doesn't make sense to actually get this. And that's why, guys, okay? Remember, okay? M1 Finance is a great platform for investing. I love it. They might be even one of the best out there. I actually like it. However, they don't have to be the best at debit cards, at savings, and also lending, and also a few other things here and there. The answer is I don't care about that. I care about you being the best at what you actually do best, and that's basically investing. So that's what I'm using it for. But when it comes to my savings, I go somewhere else. When it comes to my cash back, I have my credit card. When it comes to borrowing money, I just don't see the sense of borrowing money for my investments, then leverage it, and then run the risk of basically having my investments go down, and then boom, something happens, okay? Because again, when you are borrowing money, your investments really can't go down that far, because if they do, they will call that loan on you, okay? Or they might have to sell some of your investments to actually recover their money back. So always be very careful and ask about all the details before you go ahead and invest, okay? But guys, that's enough about what I like and also what I don't like. But right here is my portfolio, okay? My portfolio is called moderately aggressive. And what I basically did was I went on Acorns. I saw my portfolio I've been investing into for the past like 2 years or so, and I replicated that over here, and I'm starting to invest over here also in that portfolio. Now, as you guys can see right here, I invest into 7 different holdings, basically 80% into stock ETFs and also 20% into bonds. And that's about it, to be honest with you, okay? And again, guys, okay, I'm going to share this pie, my portfolio, down below. When you click that link and you sign up, basically, you get to have the exact same pie. When you sign up, you can invest into exactly what I invest into. And I also have a Patreon, and when you go in there, I'll show you exactly when I buy or when I sell, and you get all the information on top of this video, okay? So it's pretty cool. Link down below to everything I'm saying here. However, right now, 38% of every dollar I invest goes into the Vanguard S&P 500 ETF. Now, this ETF right here contains the top 500 companies in the US. On top of that, it pays me around 1.83% in dividends, okay? And on top of that, the expense ratio is around 0.03%, which is actually almost nothing. By the way, an expense ratio is basically how much you're being charged in fees every single year. And 0.03% is basically absolutely nothing. It's like so minimal. And that's why I like Vanguard, because basically the fees are so low. And if you're wondering how is Vanguard able to do this, the answer is, well, Vanguard controls a ton of money. So by having so much money, they can charge minimal fees, but also make a lot of money. And that's why their fees can actually be that low. On top of that, I also have Vanguard Developed Market ETF. Now, this right here is basically companies that are outside of the US, but they're also bigger companies. And again, because it is outside of the US, it is a little bit more risky. And that's why this ETF right here contains around 3,899 different companies, okay? That way, you're very well diversified. And on top of that, they give you a dividends around 2.13%, which is actually pretty good. And expense ratio is around 0.05. And by the way, guys, all the information is down below. That way you know exactly all the ETFs, what they are, and why I invest into them, okay? All the information is linked down below in the description. And the third one is basically a small cap ETF. Now this right here, this ETF contains around 1,348 holdings. And by the way, okay, small cap companies, basically, they grow a lot faster, but they're a lot more riskier, and you have to be careful with them. And that's why I only have around 14% of my portfolio goes into this every time I actually invest. Not that much money. And they also give a dividend of around 1.46%. And usually, small cap companies don't really give a large dividends, and that's probably why. And then I also put 10% into treasury bonds that basically pay me 1.63% in dividends, but it also pays me every single month. And by the way, those are basically government bonds. And then I also have corporate bonds, another 10% into that. But this ETF right here contains around 2,220 different types of bonds. But guess what, guys? Okay, the point is 80% goes into US based bonds, and then around 14% goes into outside of the US, and then around 4% is basically convertible bonds that are basically, hey, you can convert them from bonds to basically common stocks, but that's another video for another day. And again, guys, okay, overall, what you can see here is my portfolio is balanced in a way so I don't take that much risk. And when one industry basically goes down, one goes up, and that way everything stays balanced out. And the last two are basically one more ETF around real estate, and that pays me a lot more money, around 3.98% in dividends. And by the way, the expense ratio is only around 0.14%, and it's also by Vanguard. Again, Vanguard has very low fees. And also, guess what? When you invest into real estate investments, basically, they tend to pay you more money in dividends. But again, that's only around 8% of my portfolio. Not really that big, not really that massive, but I have it there because basically I also want that diversification into that type of the market, okay? And lastly is basically a Vanguard ETF around emerging markets. Now, this is basically outside of America and emerging markets, and that's why it's such a small fraction of my portfolio, which is basically only around like 4%. And overall, guys, as you guys can see, okay, my entire portfolio is based in a way where, hey, when some parts are actually up, other parts are actually going down. And the reason is because basically when you're investing for the long run, you want basically a balanced portfolio. That way, when you put your money into this portfolio, when other parts go up, other parts go down, but the same thing goes vice versa. When other parts go down, other parts go up, and that way you're always balanced out during market downturns and also during upturns, okay? And that's the entire goal, and that's why I invest the way I invest. And by the way, the first link in the description is going to be a link to my portfolio, and that way you can copy it over to your entire M1 Finance account. If you have one, go ahead and copy it over. If you don't and you want to sign up, you can go ahead and sign up right through that link right there. And when you sign up, I think you also get 10 bucks. So there you go, for free 10 bucks to go ahead and start investing on top of that. But guys, that's about it for this video. Comment down below and let me know, was this video actually helpful in any way? And if you have any questions whatsoever, just comment down below and let me know, and I'll answer all the questions you have. And as always, if you enjoyed this video right here, guys, well, like this video. On top of that, also subscribe to the channel and hit the bell so you're notified every time I post a video. And also follow me on TommyBryson. And on top of that, if you want to watch another video, basically on how to get started investing with $100, well, here's that video right here. You know, I'll see you guys tomorrow. Thanks for watching, and as always, peace.